kick off, I'll do a bit of an introduction about myself and Verde Plus for those of you that don't know who we are. We'll then go into talking about the property investment market changes, how to fund rental purchases, the main differences with banks and non-bank options, and what you can do next. I anticipate that this will be an hour long. I do try and keep to the time, if not finish a little bit earlier, so it shouldn't be overtime. So to kick off, just introducing myself. I have 18 years experience in the residential mortgage advisor market in New Zealand. I am a registered financial advisor and I also have a BCom. I have over 14 years experience with helping property investors. I specialise in helping those start out, so if you're very green and new to property investment, that's fine. We can definitely give you a helping hand to let you understand how it all works. But also, as I work with clients over the years, we work with clients growing their portfolios. My biggest point of difference is I have a total belief in forward planning, and what that actually means is that if I have a client that is in their due diligence process about to go unconditional on a property, and this is something that you're looking at doing, we will let you know if this is actually going to be your last purchase, i.e. is this going to have a detrimental impact on you being able to grow your portfolio. I think it's better to know that before you go unconditional rather than after the fact. I'm also the CEO and co-founder of Verde Plus, which is the brand that we operate under. So to explain Verde Plus to you a little bit more, we're about helping you to love your finances and change your life, and we do that via three parts to the business. The first part is about the dream. This is us giving free information by webinars, workshops, ebooks, blogs, market updates. It's really to allow you to get more knowledge, and the more knowledge you have, the bigger the dream can grow. The free access to our information just allows you to get ongoing content as time goes on. The second part to what we do is about planning. We've got online tools that help implement the education that we give you. The tools that we provide are around Money Map and reducing debt, saving, and obviously investment. And the final part to what we do is our Prosper, which is linking you with our advisor centre. I'm the mortgage advisor that will be talking to you tonight, but we have a range of other advisors, not just within Verde Plus, but independent companies that we can refer out to. For instance, if you have questions about KiwiSaver or other forms of investment, we can help you. So we've created a whole hub environment which puts you at the centre, and we create everything else around you at that centre point. So enough about Verde Plus. Let's talk about the loan side of what we hear tonight. So first up is the market update. So I think all of us now know that we now have 40% deposit restrictions that are in the market. We've also got restrictions on overseas income earners. We've got banks changing their investment pricing, and we've also got issues with properties that have cross guarantees. So I'm going to go through each of these four parts in a bit more detail. So number one, the deposit restrictions. 40% is now the restriction across the whole of New Zealand. So whether it's Auckland or Invercargill, you need a 40% deposit in order to be able to purchase an existing property. The exemption is that if it's a new build, we can lend 80% because that's exempt from the Reserve Bank restrictions. Now I just need to clarify what a new build means. It means a land and house package. It means that the land needs to be a new title. So if you are buying a piece of land and you don't have a build contract with the land purchase, then the land purchase will be deemed an investment, and it won't be deemed a new build because there is no build contract, and you would need to do the 40% deposit. So if you're purchasing land, it needs to have a coinciding build contract with it for you to be able to lend 80%. If you already own the land, the banks are saying because the title is already in existence, then it's not deemed as a new build, but I will say in the last week we have been given approvals for clients that did own the land and they are now doing the build, and we are getting approvals at 80%. So they're saying one thing but they are approving another. Apartments are deemed new builds. You just need to understand that the exemption applies, but the apartment criteria still gets overlaid with that. And a classic example is that some banks have lending criteria that's a 50% deposit requirement on apartments that are 40 square metres or less. So if you have an apartment, you may not get 80% with the build exemption, dependent on the size of the apartment. So you may need to just check by property what it is that you're looking at doing. We do have a secondary home exemption. Again, some banks have said this is the case and some haven't. What that means is if you live in Christchurch and you have a secondary home in Wellington, it may be that you go to Wellington a lot for work or family there. If you don't, if you're not reliant on rental income for loan servicing, then that would be deemed a secondary home and you can get 80% on that. So as long as we're not reliant on the rental income for loan servicing, you may very well be able to get 80% under the secondary home exemption. The other part is when you're upgrading your existing home. So if you are a current homeowner, you can borrow up to 80% of your home's value, and then via that you're accessing a deposit to go and buy another home. And if you go to a new bank, you can get 80% on the new purchase of the new home at 80%. So you're technically at 80% across 2 properties and 2 banks. It's just that you already had 80% lending on your existing home, which supplied the deposit for the new purchase. So you need to have the deposit for the new home in place, fully approved, before you even start looking for your second home. So that's about the deposit restrictions. The next part is overseas earners. So if you're a Kiwi living overseas and you're earning an income from overseas, it's the standard investment 60% loan to value ratio. You do need to be able to complete AML checks. Simple terms, bank account opening. AML stands for anti-money laundering laws, which are new laws that came into New Zealand a few months ago. It basically means that you may need to come into the country to open a bank account or be able to be certified at an overseas bank for the account opening. If you are a non-Kiwi and you're living and earning overseas, it is very hard to get finance at this point in time. If you are a non-Kiwi or non-New Zealand citizen but you are living and earning in New Zealand and you intend to get residency, you can borrow up to 70% for an owner-occupied property, but you can't borrow for investment lending. That may change amongst the banks, but that's the general policy of what's happening with the banks at the moment with overseas earners. In regards to bank pricing, so what we've got right now is we've got a 2-tier pricing structure. One is that there are the bank standard rates or rate card rates, and then for quite a few years now they've been offering special pricing, and special pricing has been for those who have had a 20% deposit or more. Now what's happening is that some banks are moving toward a 3rd tier structure, which means that if you're a property investor, you don't necessarily get the special pricing. You may only get rate card pricing less a certain discount. So an example of that is if a rate card rate was 4.7% and a special rate was 4.1%, but they might only offer a 0.3% discount for an investor. So the best rate that you would get would be 4.3%, so 4.4%, so 0.3 off that rate card. So there are interest rate margins that are changing for property investors. We're also noticing that when you go to a bank and you get finance offer, you get offered a cash incentive. The cash incentive could be a few $100s to a few $1,000 dependent on your loan amount. They do generally ask you to sign a business commitment form, and what that means is that you need to be with them for a minimum of 2 years. Sometimes some of the banks are 3 years or longer. But we're noticing that the cash on offer is a little bit volatile in the sense that 1 minute it could be $4,000 being offered and the next minute it might be $3,000. So it's really up and down what level of cash is being offered. We're also seeing reductions to interest-only terms, and even in the last 1 to 2 days, ANZ have dropped their 10-year interest-only policy down to 5 years. ANZ have also brought out that if you are on an interest-only term and it expires, to renew that interest-only term you need to prove a loan-to-value ratio of 70%. Now, given ANZ have a 10-year interest-only policy up until a day or so ago, the chances are when your interest-only does come up for expiry, you should be able to prove a 70% loan-to-value ratio, but you just need to bear in mind that that does exist. We're also noticing a little bit of tightening up on revolving credit approvals. So revolving credit is a way that you can access the equity in your property, and I'll talk about this a little bit more soon. ANZ have come out and said that they will restrict revolving credits to being no more than $350,000, and you must be at 70% or less. So for an owner-occupied property, you can actually borrow up to 80%. But if you want to borrow up to 80%, the maximum revolving credit you could get at ANZ is only $60,000. So if you want the larger revolving credit, it has to be less than 70%. Now that is just one bank. Other banks sometimes don't even let you have a large revolving credit. It may be that they pre-approve you for a revolving credit, and what that means is, yes, we'll approve you, but we want to see a purchase agreement first. So it's technically like a pre-approval rather than access to full funds. We'll talk about more revolving credit shortly. So cross guarantees. Now this is quite important, because if you have more than one property with the same bank, you actually may need to get loan approval if you wish to sell a property. What that means is Westpac came out with saying, if we've got more than 2 properties with one bank and you go to sell one, we're going to automatically keep all of the proceeds from sale. So we will effectively, when we get given a discharge notice, we'll find out what you're selling for and we'll ensure that we reduce debt by all of the proceeds amount. However, if you want some sale proceeds released, you actually need to apply for that. So the big part to know is that if you've got more than one property with one bank, you should get an approval to sell a property. You should get an approval to release a property if you're just looking at refinancing one property away. And the reason being is that the bank needs to check that the property or properties that will remain, they'll need to get updated valuations to ensure that the existing level of debt meets the 60% loan to value ratio. So that's quite an important thing to know. What I find interesting about all of this is the policy that the banks had post-GFC or post-global financial crisis. So you'll find that as much as we're in a very buoyant property market and we've got high property value growth, the restrictions that are in place are actually very similar to what it was back in 2008, 2009 post-GFC. So buoyant property market, but not a buoyant lending market. So I've got a question for you now, so we will open that up to the attendees. So just to answer the question, do you have more than one property with the same bank? You just simply answer yes or no, and Jan will let me know what percentage we are at.
And just perfect timing, everyone has voted. 75% of the audience says yes and 25% says no.
Okay, so that's not uncommon. So If you do have more than one property with the same bank, I would be advising that you just put that under review. It just means that if you've got an interest-only time frame expiring on one property but not the other, you don't get caught with these LVR changes. There may be the potential for further LVR changes, so you may not want to get caught with that, and if there is the potential that you may look to sell, again, you may not want to. We're definitely in an environment where spreading your lending across multiple banks is definitely the better way to go right now. Okay, so moving on to how to fund rental purchases. So you may sort of think, gosh, 40% deposit restrictions, there's no way I can get into the rental market. Well, you actually can, and to be fair, it's not as difficult as what you may think it would be. So you don't have to have access to cash to be able to purchase, you just need access to equity, and the use of a split loan structure to spread your risk makes it a lot easier for you as well. So let's go sort of through what I call Property Investment 101. So we'll just do a recap on how you make this happen. So your purchase capacity. So how do you work out what your purchase capacity is in the current environment? Let's say you've got a home. Now this may be a rental property, but let's say it's a home and you've got a value of $700,000 and a loan of $300,000. Your equity is the difference, which in this case is $400,000. But you need to have usable equity, and usable equity means that you can access up to 80% of the value of your property, and in this case that equals $560,000 less the loan that you currently have means that you've got usable equity of $260,000. Now that $260,000 isn't your purchase capacity, that's the deposit funds that you have available. So if you then look at wanting to build a rental portfolio, all you do is take your purchase capacity is your 2.5 or 5 times your deposit. 2.5 times is with a 40% deposit restriction, and 5 times your deposit is the 80% build exemption. So this particular person has access to 260. 40% deposits gives them the ability to purchase up to 650,000. With 20% deposits, it's 1.3 million. Now, this of course is purchase capacity only based on your equity position. It does not take into account your loan servicing ability, but simplicity is multiply your deposit funds available by 2.5 or 5 to get your purchase capacity. So how to purchase? The simple way to purchase is using the same bank. So we'll just go through this first. So your same bank is a value of 700,000. We've got the home loan of 300, and we've got equity of 400,000. You then want to go and purchase a rental property. So let's assume that that purchase is 400,000, and this bank would give you a $400,000 loan. This transaction and approval could actually happen within hours. It's very quick. They know and have history about you. They've got all your loan information, so that's fine. But what they've actually done, you can't purchase 100% finance. So what they've actually done is they've done a cross guarantee between your home and your rentals, which means your home is now fully exposed to all of that rental debt of $400,000. What my position on this is A, try not to use the your home as a cross guarantee for any other property unless you absolutely have to, and also to reduce the risk of changing bank criteria is to use multiple lenders. So in order to do that, how you need to set that up is we then access a type of loan product called a revolving credit. So the revolving credit is essentially taking your usable equity, which is that 260,000, and it's saying to the bank, hey, based on my income and my equity position, I would like you to give me access to 260,000. Now that's literally an overdraft that gets loaded to your bank account, and if you wanted to, you could literally go and buy yourself a fast car. I would like to think that you're a bit more smarter than that and that you would buy some income generating assets. So the 260 would become a revolving credit loan. A revolving credit loan is a variable interest rate loan, so it's not high overdraft rates, it's just your standard variable rates. In most cases the bank will discount a variable rate, so you could be paying 5 or less than 5% for that. You pay a monthly cost to have access to the facility of around about $10 a month. Some banks it's a little bit more, some a bit less. And you only pay interest on the funds you use. So if you have a facility set up of 260 and you don't buy a property for 4 months, you're not paying any interest on that money at all. Then you purchase a rental property and you need to pay a deposit. It's at that point that you'll start paying interest on that revolving credit loan. When you withdraw a large amount from your revolving credit for deposits, you can at any point in time fix that loan on a lower rate. So just because it starts on a variable rate as a revolving credit loan, it doesn't mean that we can't then contact the bank and say, look, we actually would like to fix 100,000 of that at 4.2% and the balance remains on a revolving credit. So the revolving credit is a large overdraft. It's attached to your bank account. You can use the money at your free will. It's charged on a variable rate, but you can fix it on a lower rate at any point in the future without any additional cost. So let's have a look at how this would work. So you've got your home with Bank A, and again this may be a rental property, not necessarily your home. You have a 260,000 revolving credit on that property. You then go and purchase a rental property for 400,000 and you get a 40% deposit out of the revolving credit. So you can go in and withdraw 160,000 from the revolving credit. The balance of the funds, or the 60% main loan of 240, is secured on the rental property at a secondary bank. You still have 100% borrowing. It's just that you've used a split bank structure where your home is now only exposed to 160,000 rather than 400,000 as you would if you use the same bank. So you've borrowed 100%, you've used a split loan structure, your deposit is secured on your home and the balance is secured on the rental. Now that means that you can then take the balance of the revolving credit at 100,000, you can go and purchase a secondary property, you can put that second property at Bank C and continue on while you've still got the funds. So let's just talk about bank and non-bank options. The banks, as we've stated, are at 60% lending, so it's now an environment where you need to look at non-bank options. In New Zealand, we used to have dozens of non-bank lenders and they all went out of the market post-GFC. In Australia, it's actually a different market environment. There are a lot of non-bank lenders in play in Australia, but New Zealand, not so much. The non-bank lenders don't need to abide by the Reserve Bank ruling, so the restrictions that are in place for the major trading banks aren't, they're basically not in place for the non-bank lenders. So the two main non-bank lenders in New Zealand is Resimac and Liberty. They can lend up to 70 and 80% on investment. Now this morning when I wrote up some of this presentation, I had 80% investment there, but as of this week, as in basically Monday, Liberty have reduced their lending down to 70% maximum for property investment, so they will no longer be able to do lending at 80%. And Resimac, interesting enough, Resimac have about a 10 to 15 day approval time frame, and they have specifically said that if their investment property loan book starts outweighing their core loan book of their core products, then they will also be pulling back on the amount of investment lending they do. So even though the non-bank lenders aren't don't need to abide by the Reserve Bank rule, most of their funding actually comes from the banks, and so therefore the banks are also putting pressure on them to reduce their levels of lending. So we can get 70% comfortably. With the likes of Liberty, it's a very fast approval. We're getting a 3-day approval time frame from them. It's a variable rate of 5.59. Obviously that is open to change. They're not offering fixed rate options for property investors, so it is just a variable rate. They will do interest only. The paperwork that they need for applications is fairly much the same as the banks, but they are now limiting approvals to 70%. But as you can see, if you want to extend your rental portfolio, you definitely can by doing investment lending at 70% rather than the 40% and deposit. It may just make the difference between you buying 2 properties or 3 properties instead of maybe 1. So one of the things that I want to talk to you about tonight is how Verde Plus can help. So one of the things that I have been completing for clients for quite some time is free lending reviews. And what the lending reviews basically means, it's taking a snapshot of your current financial position, and that is income, current debt commitments and other commitments that you may have. It's looking at the values of your properties and doing that, and it's basically saying, based on that information, this is your purchase capacity, this is what you can afford to purchase. But we also look at your loan servicing ability, so we balance the deposit versus the income side and say, okay, based on deposit you could purchase this, but based on loan servicing you can purchase that. And what that helps you to see is that there's generally a restriction somewhere. Either you'll run out of deposit funds or you'll run out of loan servicing. But it allows you to know that when you're looking at purchasing a property, you really need to be looking at cash flow. If you've got income restrictions, or if you're looking at deposit restrictions, you may need to purchase more for longer term capital gain. So it gives you a bit of a direction in where you need to focus your investment plans with. The other thing that we do is we make an assessment when we're doing loan applications with clients purchasing properties, and we're seeing that it's getting very close to the wire of it being the last purchase. We'll be informing you that if you were to go ahead and buy that property, it would be the last one, that you really do need to be looking at recycling a deposit and getting a stronger deposit base behind you, or that it is tightening up on a loan servicing ability and that you may need to look at better cash flow. So we complete free lending reviews for all our clients, and we can do that now, and we can do it a year from now. It's just an ongoing process that we do. We also do home loan assessments, so even though we specialise with property investors, we don't overlook somebody's home loan. And it's really important to find the best loan structure for you for debt reduction. The sooner you can reduce debt, obviously the sooner you can build up equity for further investment. But I think the big thing with that is I find that a lot of clients are paying down their debt and they're reducing their loan, which is great, but I would like clients to reduce loan and at the same time access revolving credit funds for investing. So you're not actually reducing the total limits borrowed, you're just reducing the home loan debt but increasing the investment revolving credit. And it's much easier to do that before you pay lump sums and do things. So even though you think of a mortgage advisor as someone to go to when you're buying a property, Verde Plus isn't like that. We are here to advise you on anything to do with your loans. So whether you're looking at making a lump sum payment, classic example, many clients have got funds over in the UK that they will look at bringing over. They've got home loans. Instead of paying off $100,000 off their home loan and then basically reapplying to get it back as a revolving credit, we can do it all in one go. So home loan assessments just go part of our process. The other thing that we do is we do a free break cost assessment. So what that means, break costs are when you are on a fixed rate and you've locked in for a period of time. If you go to break that contract, the bank will charge you a penalty. Now, what's important with that is that to reduce your interest rate, you do that for two reasons. One is because you want to save money over the long term, and that's more of a homeowner's position. When you're a property investor, the big thing that you want to do is create cash flow, and so many property investors can be sitting on higher rates at the moment, and even though a break cost might be $4,000, that breaking of that rate could give you $500 a month better cash flow. So there are many property investors out there right now that once they've got a break cost assessment completed, they may very well say, look, we're happy to pay $4,000 or top up a loan by $4,000 or do that to get the cash flow relief on our monthly expenses. Now, in order to be able to do that, it's a pretty simple process. We get an email from you with loan account number and what your mortgages are, and we ask the bank for break costs, and then we complete a report for you. You're not obligated to do anything, but it does just let you know where you're at with all of your loans and your rates. You don't need to change banks to break rates and refix, but obviously some banks offer that lovely carrot of, hey, we'll give you some cash, and it might be a few thousand to get your business. And if you're paying a $3,000 break cost, but another bank is offering you $4,000 to take your business, then you may be inclined to change banks because it literally covers the cost of breaking to go onto a lower rate. So that is also an option for you. We also assess for revolving credit approvals. So what I mean by that is we look at your financial position, we let you know what is expected that you could get approved as a revolving credit, which then lets you know what your purchase capacity is. We'll also let you know with the bank of where you're at what that likely process will look like. For instance, will the bank give you a large revolving credit? Will they limit it to a small revolving credit and make the balance subject to a purchase agreement? How is it that you can overturn that bank's decision? What are the other options available in the market? Does it mean that you need to break existing loan structures to get access to the larger revolving credits? But again, we're a numbers-based business. We'll get the numbers from the bank, we'll get break costs, we'll get approvals, we'll get all of those, and then we'll let you know these are all the options available to you, and then you just sit at home and say, right, that's the option that is most preferred for me. So we provide the information so that you can make the decision. We'll help any investor with pre-approvals. I believe that there are some advisors in the marketplace that don't like doing pre-approvals. I personally really love doing them. It gets you ready. It means that you are investment ready. You can talk to property finders and property developers. You can get in on deals because you can move quickly. So a pre-approval means that we go to a bank and we get you based on your income assessed, and all we then have to do is show them the property details to get that turned around. And we're talking anywhere, if we need to, a few hours to a couple of days to go from a pre-approval to an unconditional offer. But it does mean that you know that you're approved, and it means any partner that you're working with is more inclined to really push hard and help you because they know that you're also approved. So it really gives you a big leg up in negotiating on deals to do that. Of course, the other part of what we do is any new purchase approvals. So if you're purchasing or going under contract or going to auction or anything like that, we will help with any loan application to do with that. So as advisors, our services are free. We get paid commissions by the banks when we do business for you. When it's long-term investment lending, that's just how it goes. If you're property trading, i.e. you're looking at buying a property to then sell the property, we essentially have to pay the commission back to the bank, but that's when we negotiate with the client a fee for doing that type of business. We discuss that fully up front so every client knows. Just one of the things that I would also like everyone to bear in mind is with these cash offers that the banks have been given, a few clients have been getting caught out, not through using our services, but they've told us after the fact when they've used or gone direct to the bank or used other advisors, is that they sign the cash forms, which is that cash commitment. So if you get $4,000, it means that you remain with the bank for 2 years or 3 years. And sometimes it's easy to forget that you've done that, and so you may be in the process of selling a property or refinancing from one bank to another, and the discharge goes into the bank, and out comes all of these fees, which includes the cashback repayment. So it can be a little bit of a surprise and a little bit of shock in your numbers, so please bear that in mind when you're looking at restructuring and doing work, to remember what time frame you signed cash forms with the banks on. So that's pretty much what I just wanted to go through with you tonight. It's a real introduction to Real Estate Investor members to Verde Plus and what we do. Any people that come onto our membership database, we do market updates, we do webinars, we run workshops on anything from money management through to managing rental money flow to paying off your home loan faster. We do blogs. We also liaise with you on what other services you may need. KiwiSaver advice, there may be debt consolidation advice to do with some consumer debt. It may be that you have funds, money that you want to put in funds and need something on that. So we'll just liaise with you and then pinpoint you in the direction of the advisor channel and ensure that that process is a smooth process. So this webinar is the intro. There will be more to come, but if you need anything to do with any of your loans and your interest rates, anything like that, all you need to do is use the link that you see on the screen, and Jam is going to put the link up. Jam? Yep. So when you registered for the webinar, it sent you to essentially a thank you page. That's where you can go in and complete your details and let us know. So the minute that you do that, or not necessarily the minute, but within 24 hours of you doing that, we will be in contact with you asking you what you need, and then we'll fulfill that service for you. So hey, here to help if you're new, and here to help if you're building a portfolio, here to help if there's been a lot of change and you just really need to know how to get out of a pickle. That's what Verde Plus is all about. So thank you for joining us tonight. Let me know if you have any questions. You know where to contact us now, and happy to be on this journey with you. Thank you.